It's the Side Quest Podcast.
Imagine for a second that you are bidding on a starter home.
Right.
You know, you've done everything right. You saved up the 20% down payment. You polished your credit score. You get a mortgage pre-approval.
The whole 9 yards.
Exactly. You put in a highly competitive offer, and you lose, but not to another family.
Yeah.
You lose to a multi-billion-dollar corporate entity armed with a briefcase full of cash, bypassing the inspection entirely.
It's brutal.
It really is. Now, imagine that happens to you 20 times in a row. That is the exact story of Rachel Wiggins, a mother of two from Houston, who literally lost 20 consecutive bids to institutional investors.
Oh, wow. 20 bids.
Yeah. Welcome to the modern American housing market.
I mean, it completely shatters the traditional expectation of a level playing field, right?
Yeah.
We've historically viewed homeownership as this individual neighborhood level pursuit.
Right.
But in specific areas, it has transformed into a highly engineered, institutional battleground.
And unpacking that battleground is exactly what we're doing today. So welcome to today's deep dive.
Happy to be here.
We are digging into a massive stack of sources today, detailing Wall Street's role in the U.S. housing market, the rise of corporate landlords, the crisis of homeownership, and honestly, what is actually driving your housing costs through the roof.
Yeah, we'll be breaking down the financial machinery that makes all of this possible, the policy failures driving it, and the very real supply and demand crisis underneath it all.
But before we jump in, a really crucial note for you listening. Our sources today touch on deeply charged political issues.
They definitely do.
Yeah, and they outline recent 2026 legislation involving some very prominent right-wing and left-wing figures. So I need to explicitly state right up front, we are not taking sides or endorsing the viewpoints, policies, or political figures mentioned today.
Exactly.
Our mission is strictly to neutrally report the facts and ideas contained in the source material. We're just here to help you understand the landscape.
Right. We are analyzing the mechanics of the housing market, not taking a political stance.
Okay, so let's unpack this, because we actually have to start by busting the single biggest myth dominating social media right now.
Oh, this is a big one.
It's everywhere. If you go online, you will see millions of posts, videos, angry rants blaming one specific bogeyman for buying up all the single-family homes, and that is BlackRock.
Right. And that narrative is entirely false.
Entirely.
Yeah, it is a
Right.
profound case of mistaken identity that has just spiraled totally out of control.
I mean, blaming BlackRock for outbidding you on a house is basically like yelling at your local bank teller because the guy standing next to them in line just bought the winning lottery ticket.
That's a great way to put it.
You're yelling at the wrong person. Let's clarify what they actually do.
Okay, so BlackRock is a fiduciary, for those unfamiliar with the term. It basically means they manage other people's money.
Right.
So when a teacher's pension fund, or say your personal 401k needs to be invested, BlackRock puts that capital into stocks, bonds, and broad mortgage-backed securities.
They don't buy the houses themselves.
Exactly. They help finance new home construction by lending money to builders, but they do not go out and buy individual residential homes. The company everyone is actually furious that the real giant in the U.S. single-family rental market is Blackstone.
Blackstone, not BlackRock. One letter difference, but a totally different business model in this context.
Right. Blackstone is a private equity firm, and following their 2024 acquisition of Tricon Residential, they built a portfolio of roughly 58,000 to 62,000 homes.
Wow.
Yeah, and they operate through subsidiary firms like Home Partners of America and Tricon. So the internet rage is, totally valid in its frustration about corporate landlords, but it is aimed at the completely wrong target.
Okay, so to understand how Blackstone and these other massive corporate entities even got into the business of being your neighborhood landlord, we really have to look at the timeline.
We do.
And this traces a direct, undeniable line right back to the wreckage of the 2008 financial crisis.
Yeah, the post-2008 landscape was really the perfect incubator for this. Millions of Americans had been sold these predatory subprime mortgages that they fundamentally could not afford.
Right.
When that bubble burst, the market just went into absolute freefall. I mean, you had entire neighborhoods in places like Phoenix, Atlanta, and Las Vegas just sitting empty.
Ghost towns.
Basically, yeah. The houses were quite literally rotting, which ended up dragging down the property values of anyone who actually managed to keep their home.
And the families who normally would have stepped in to buy a cheap fixer-upper just couldn't do it.
Yeah.
Their credit was destroyed. Or banks simply stopped lending to regular people out of sheer panic.
There was genuine terror among economists back then that the lack of demand would cause home prices to collapse permanently.
Which would have been catastrophic.
It would have deepened the Great Recession into a full-blown depression. And this is the exact moment Blackstone's CEO, Steve Schwarzman, had an epiphany.
He saw an opportunity.
He looked at the wreckage and realized the single biggest asset class in the world, American residential housing, was trading at historic rock-bottom lows.
So they swooped in. Starting in 2012, Blackstone uses a subsidiary called Invitation Homes and just starts hoovering up foreclosures.
Yeah, by the thousands.
Within 4 years, Invitation Homes scooped up nearly 50,000 houses.
And we really have to pause and ask here, why didn't Wall Street do this in the 1990s or the 1980s?
Oh, that's a good question.
The answer is technology. Historically, managing 50,000 single-family homes spread across a dozen states was just impossible.
Right, like how do you deal with 50,000 leaky toilets?
Exactly. You couldn't scale the leaky toilet problem. But by 2012, cloud computing, mobile apps for maintenance contractors, digital rent payment portals, all of that had matured.
So the tech caught up.
Right. Technology finally allowed Wall Street to manage scattered physical assets with the exact same efficiency as a stock portfolio.
Okay, so they absorbed this massive amount of rotting housing stock, fixed them up, and basically stabilized a collapsing market when no one else had the capital to do it.
Which, by the way, is the primary argument the industry still uses to defend its existence today. They provided a floor to a market that was in total freefall.
Okay, hold on. Let me challenge that on behalf of the listener for a second.
Sure, go for it.
If they bought 50,000 houses back then, figured out the technology to manage them,
Yeah.
and kept growing, aren't they basically buying up everything?
It feels like it, right?
Yeah. I mean, if Rachel Wiggins' last 20 bids, it certainly feels like Wall Street owns the entire market.
Well, the national data actually tells a surprisingly counterintuitive story.
Okay.
If you look at the entire United States, all institutional investors combined, and by that we mean any company owning more than 1,000 homes in at least 3 markets, they own just 1% of the total U.S. single-family housing stock.
Wait, really? Just 1%?
Just 1%.
That honestly sounds like a PR spin to make them look smaller than they actually are.
I get that. But even if you zoom in strictly on the rental market, the top 5 largest investors combined own nearly 2% of single-family rental homes nationally.
Okay.
That's about 300,000 homes out of roughly 80 million single-family homes in the country. Invitation Homes is the biggest, with over 85,000 wholly owned properties. So in a pool of 80 million, they really are a statistical drop in the bucket.
But wait, a national average is basically useless when you're talking about real estate, right?
Yes.
Because they aren't buying 1% of a town in rural North Dakota and 1% of a town in Maine just to keep things perfectly balanced. They are hiding behind a national average.
That is the critical distinction right there. The national average conceals enormous hyper-local regional concentration.
Right.
These corporate landlords do not buy randomly. They target very specific neighborhoods. Overwhelmingly, they go after lower and middle-income communities in the Sunbelt states where population growth is booming.
Okay, and our sources show the concentration is massive in those specific hotspots.
Grasp.
Like in Atlanta, institutional ownership is 4.2%. In Dallas, it's 2.6%. In Houston, 2.2%.
Yeah.
So if you are a listener out there trying to buy a starter home in one of these specific zip codes, you are not competing in a free market. You are competing in a heavily concentrated, hyper-local monopoly.
Exactly. Because when you own that much inventory in a single zip code, you essentially set the floor for rent.
Yeah.
You don't have to compete with the mom-and-pop landlord down the street because you effectively own the street.
Okay, so knowing that they are laser-focused on these specific neighborhoods, let's get into the mechanics of it. How did Wall Street so easily outbid ordinary families trying to buy those exact same homes?
Right.
Because they weren't just paying cash out of their own pockets, were they?
No, not at all. The mechanism here is heavily tied to government policy. After 2008, the Federal Reserve implemented near zero interest rates and a policy called quantitative easing.
Okay, let's translate quantitative easing for the listener who isn't a central banker. You essentially mean the Fed was creating money and handing it to major financial institutions at bargain basement rates, right?
Effectively, yes. They flooded the financial system with liquidity to keep the broader economy moving.
So cheap money.
Insanely cheap money. Major institutions could borrow billions of dollars for next to nothing. But at the exact same time, the government pressured local banks to dramatically tighten mortgage standards for everyday people.
Because loose mortgages caused the 2008 crash in the first place.
Exactly.
Talk about a tilted playing field. It's like showing up to a foreclosure auction where Wall Street walks in with a briefcase full of cheap government-backed cash that costs them almost 0% interest.
Yep.
Meanwhile, ordinary families are forced to jump through a dozen bureaucratic, burning hoops just to get a standard 30-year loan approved.
Of course, the guy with the briefcase wins.
Exactly.
And once they won the house, Wall Street introduced a piece of financial engineering that honestly changed housing forever. In 2013, they executed the first ever securitized financing for residential rental homes.
Securitization. That is a pretty big concept. Break down exactly how that works and why it matters here.
Okay, so imagine a renter in Atlanta writes a $2,000 rent check.
Okay.
Wall Street basically took thousands of those monthly rent checks from all across the country, bundled them together into a financial product called a bond, and then sold those bonds to global investors.
Like who?
Like a pension fund in Norway or maybe a sovereign wealth fund in the Middle East.
So they essentially decoupled the local housing market from the local economy.
That's exactly what they did.
The rent is no longer just paying off a local bank's mortgage. It is paying a coupon to a global investor halfway across the world.
Yes. They turned residential housing into a massive Wall Street asset class, very similar to corporate debt.
Wow.
By doing this, Invitation Homes was able to fund its massive expansion using roughly 75% debt and only 25% equity. They used that incredibly cheap borrowed money to basically build an empire.
Unbelievable. We see the financial mechanics, the securitization, the cheap debt. But what happens when a community's homes stop being places where families actually put down roots and instead
Wow.
become just lines on a corporate spreadsheet?
Well, managing 85,000 homes demands relentless, aggressive efficiency. And when a massive portfolio is optimized purely for shareholder returns, the human reality of the tenant often becomes a casualty.
Which is exactly what the Federal Trade Commission found.
Right.
Because in 2024, the FTC brought a massive case against Invitation Homes. And they didn't just find a few bad property managers. They found systemic exploitation.
The FTC detailed a whole litany of deceptive tactics. To maximize that yield for their securitized bonds, Invitation Homes was saddling renters with hidden mandatory junk fees.
Ugh, junk fees.
Yeah, and these weren't small. They could total more than $1,700 a year per tenant. The FTC also found they were unjustly withholding security deposits and systematically ignoring routine maintenance requests.
But I think the most shocking detail from the sources was what they did during the pandemic.
Oh, the eviction stuff.
Yeah. When the federal eviction moratorium was in place to keep people off the streets, Invitation Homes intentionally steered renters away from filing the official CDC declaration that would have legally protected them.
Right.
Instead, they tricked renters into filling out their own company-created form called a hardship affidavit.
A form that provided zero actual legal protection from eviction.
That's just wild.
It was a calculated deception to bypass federal law. Now, ultimately, Invitation Homes settled with the FTC for $48 million, though they did not actually admit wrongdoing.
Right, but $48 million sounds like a hefty fine until you look at their balance sheet.
Oh, absolutely.
That amount was a mere 0.02% of their market cap. It's literally pocket change. It's the equivalent of a parking ticket for you or me.
Yeah.
It really raises a serious question about whether these fines actually deter the behavior or just become, a cost of doing business.
Well, let's take that systemic abuse a step further, because the issues go beyond individual corporate landlords. We also have to look at the Department of Justice's antitrust lawsuit against a software company called RealPage.
This is a fascinating pivot here.
Yeah.
Because RealPage isn't a landlord. It is the pricing algorithm that the landlords use.
Right. RealPage basically acted as an algorithmic intermediary. Landlords all across the city would feed their private, competitively sensitive pricing and occupancy data into the software.
Okay.
Then the algorithm would aggregate it all and tell every participating landlord exactly how much to raise the rent.
Using RealPage is basically like sitting down at a high-stakes poker table where every player secretly shows their cards to the dealer, and then the dealer tells everyone exactly how much to bet.
That's a perfect analogy.
It is an invisible cartel.
It artificially inflated rents across entire markets, completely overriding the normal forces of supply and demand. In fact, a report from the Biden White House found that this algorithmic price setting cost U.S. renters nearly $4 billion in 2023 alone. One landlord famously bragged they were able to raise rents by 25% within 11 months of turning the software on.
Okay, so we have Wall Street outbidding families, we have systemic junk fees, and algorithmic cartels.
Yeah.
It leads to the ultimate question.
Which is,
If we ban these corporate landlords, if we outlaw the algorithms, does the housing affordability crisis just go away? Can Rachel Wiggins finally buy her house?
the short, painful answer from nearly every single economist is no.
No.
Because corporate landlords, as problematic as their localized monopolies and practices are ultimately a symptom of the crisis. They are not the root disease.
Right. The actual disease is supply.
Yeah.
We simply do not have enough houses.
The fundamental reality of the American housing market is a catastrophic shortage. According to Freddie Mac data from late 2024, the United States has a deficit of roughly 3.7 million housing units.
The math on this is staggering when you actually zoom out.
It is.
Since 1980, the U.S. population has grown by more than 50%. We added over 100 million people.
Mm-hmm.
But our home construction completely flatlined compared to previous decades. We just stopped building enough places for people to live.
And we have to be very clear about why we stopped building. It wasn't a lack of lumber or a lack of land. It was driven by local policy.
Local politics.
Yes. Restrictive zoning regulations make it incredibly difficult and sometimes literally illegal to build multifamily housing, duplexes, or denser, more affordable homes in most American cities.
Right. This is the any buy phenomenon, not in my backyard.
Exactly. Let's say a developer wants to buy an empty lot near a transit hub and build a fourplex.
Okay.
NIMBism means existing homeowners will pack city council meetings for months to complain about traffic, parking, or preserving neighborhood character.
Because they know that restricting new housing artificially inflates the value of their own existing homes.
Exactly. And that local resistance triggers mandatory environmental reviews, historical preservation studies, endless legal delays.
It just drags on.
Right. Before the developer has even poured a single ounce of concrete, they've spent $100,000 on zoning lawyers and holding costs over 3 years.
That's insane.
Studies show that this restrictive bureaucracy can make homes more than 50% more expensive than the actual physical cost of materials and labor.
Wow.
When demand surges and supply is artificially choked by local law, prices skyrocket. Invitation Homes owning 85,000 houses does not explain why 27% of American renters are spending more than half their income on rent.
Right.
A 40-year generation of policy failure around construction explains that.
But because the human toll of this is so visible, and because the idea of a faithless corporation buying your neighborhood is so visceral, politicians have finally been forced to act. Which brings us to a remarkably rare alignment in modern politics.
The legislative response we are seeing in 2026 is genuinely unprecedented.
And as we walk through this 2026 political backlash, I want to explicitly remind you, the listener, of our strict impartiality rule here.
Very important.
We are simply reporting the legislative actions detailed in the sources. We are strictly neutral, and we are not endorsing any of these political figures or their policies. We're just looking at the facts.
So looking at the timeline, the bipartisan nature of this is really what stands out. On January 20, 2026, the Trump administration issued an executive order explicitly aimed at preventing large institutional investors from buying up single-family homes that could otherwise be purchased by families.
Okay, and following that executive action, the Senate makes a massive move. They pass the 21st Century Road to Housing Act in an overwhelming 89-10 vote.
A huge margin.
Huge. And the co-sponsors on this bill are what really caught my eye.
Yeah.
It was Republican Senator Tim Scott and Democratic Senator Elizabeth Warren.
Yeah.
You almost never see those two names headlining the exact same piece of major financial legislation.
It underscores how universally potent the anger over housing has become across the entire political spectrum. And the Senate Act has real teeth. It essentially bans investment funds that control 350 or more single-family homes from purchasing any additional existing properties.
Okay, so it caps them.
Yes. But crucially, it doesn't just attack the symptom, it attempts to tackle the disease. The bill includes financing, permitting, and environmental reform incentives aimed at the supply side.
Okay, trying to lower local barriers and speed up new construction.
Exactly.
Then, on May 20, 2026, the House passes its own version of the act. They maintain that core ban on corporate purchasing, but altered some of the supply-side details, meaning it is now heading to reconciliation between the two chambers to iron out a final law.
And we really can't ignore the state level either. While Washington moves slowly, 22 states have introduced their own aggressive bills.
Like where?
Well, New York introduced the End Hedge Fund Control of New York Homes Act. California has a bill banning mega investors from further acquisitions entirely.
Wow.
And Texas introduced legislation limiting corporate ownership of rental homes to a maximum of just 10 properties.
Okay, since this legislation is actively reshaping the market right now, let's lay out the honest case for both sides of this debate. I want us to give the listener a perfectly balanced view of the arguments for and against institutional investors.
Sure, if we connect this to the bigger macroeconomic picture, the case for institutional investors is built on stability, efficiency, and capital deployment. First, as we established earlier, they stepped in and stabilized a crashing market in 2012.
Right.
Second, because of their massive scale, they actually have the capital to offer professional, consistent property maintenance, which can sometimes revitalize neighborhoods that might otherwise face blight from absentee landlords.
And the sources also point out a pretty interesting demographic shift.
Oh, yeah.
While these firms definitely make homeownership harder, providing high-quality rental houses actually diversifies the suburbs. It allows families who can't afford a $60,000 down payment to rent a house in a neighborhood with better public schools.
That's a really valid point.
Plus, their overall national footprint is statistically small, and they are increasingly bringing their massive capital to fund brand new construction, the build-to-rent market, which technically adds to the overall housing supply.
Right. Now, on the other side, the case against institutional investors focuses heavily on market distortion and systemic risk.
Okay.
Their hyper-local concentration absolutely destroys the starter home market for first-time buyers in specific fast-growing cities.
Like Rachel Wiggins in Houston.
Exactly. And the economies of scale that make them efficient for Wall Street also enable systemic tenant abuse at scale. Which the FTC explicitly proved with the junk fees and that whole pandemic eviction deception.
But fundamentally, I think the biggest argument against them is philosophical, and it goes right to the core of the American economy. In the U.S., home equity has historically been the primary vehicle for working-class and middle-class families to build generational wealth. It's how you pay for your kids' college or fund your retirement. When Wall Street buys up the neighborhood, they intercept that working-class wealth generation and convert it into corporate profit, effectively creating a permanent renter class.
Right. It transitions housing from a utility that builds community wealth into a financial instrument that extracts it.
Exactly. So we've covered a massive amount of ground today, and the takeaway is pretty clear. Wall Street buying homes is a real, measurable, and highly problematic issue if you were trying to buy a house in one of their targeted local hotspots.
Yes.
But the grand internet narrative that BlackRock is buying the entire country is wildly distorted.
The data tells us that corporate landlords definitely exacerbate the pain at the local level, but they are not the architects of the national affordability crisis. We simply didn't build enough homes for 4 years.
Removing corporate landlords without fixing that 3.7 million home deficit through serious zoning reform is basically like putting a Band-Aid on a snapped femur.
That's a very graphic but accurate way to put it.
It might make you feel like you did something heroic, but the bone is still broken. You still have to physically build the houses. You still have to clear the bureaucratic red tape. And you still have to level the playing field so ordinary people like Rachel Wiggins can show up to an open house without competing against a corporate algorithm.
Absolutely. And that honestly leaves us with one final lingering question for you to ponder.
Okay, let's hear it.
If this 2026 bipartisan legislation successfully becomes law and permanently bans Wall Street from buying existing single-family homes, well, where will that massive mountain of institutional capital go next?
That is the big question.
Will it finally be forced to fund the new housing construction that America so desperately needs? Or will Wall Street simply find another essential piece of the American dream to securitize?
We'll see you next time.